Today we're looking at the Blackrock SP500 ETF IVV listed on the Australian Stock Exchange. We'll look at how much dividend income it provides each year, dividend yield, payment frequency, total performance, and the management fee. IVV is an ETF provided by Blackrock, who own and operate the fund. Blackrock are the ones who own the underlying shares in each of the individual companies. So when we buy shares in the ETF, we buy from Blackrock, who continually issue new units in an open-end fund and not the individual companies inside the ETF. IVV tracks the performance of the S&P 500 index before fees, expenses and tax. The ETF provides low-cost exposure to the S&P 500 index and is a widely recognized benchmark of US stock performance that is dominated by the largest US companies in leading industries of the US economy. This ETF suits buy and hold investors primarily seeking long-term capital growth with some dividend income. It pays distributions, which are dividends from the ETF, 4 times a year with a yield of 1.26%, which would equate to $1,260 of dividend income for every $100,000 invested. It has a management expense ratio of 0.04% per year, so for every $100,000 invested, it will cost $40 per year in fees, and this is automatically subtracted from the ETF unit price, so you won't actually see any fees being taken out of your brokerage account. Since IVV tracks the US markets, it is concentrated towards technology companies. The largest portion of the fund, at 30%, is in technology, followed by financials at 13% and healthcare at 12%. Materials, utilities and real estate companies make up the smallest percentage of the fund, under 3% each. The benefit of investing in the S&P 500 include its historical outperformance long-term over broader indexes and other countries, market breadth covering a wide range of American industries, and instant diversification, reducing the impacts of specific industries or companies. The bulk of the US stock market returns have come from capital gains, and with dividend reinvestments, this leads to larger compounding growth rates over time. Since inception, IVV has had an average annualized return of 6.6%, which includes both capital growth and dividends. Past performance is no guarantee of future performance, but it's a good sign of improving business fundamentals, continually driving each individual stock higher within the ETF. With dividends reinvested, the cumulative returns become much better. Reinvesting these dividends creates a larger compounding effect, exponentially increasing our returns the longer we have our money in the fund. This is the approach I take investing for the very long term using ETFs, to one day live off the investment portfolio as passive income through dividends or selling down small parts of the position.